To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jelinski, the financial quarterback. Don't touch that dial. Hi, everybody. This is Josh Jelinski. I was going to say hi, everybody. This is JJ, the financial quarterback, with JJ, the CPA. We're talking everything you want to know about taxes, but we're afraid to ask with the leading CPA in the country, everybody's favorite CPA, America's favorite CPA, JJ, the CPA. Straight, my brother from another mother. How have you been?
I'm doing well. Thank you so much for having me on the show. Once again, always an honor. I've been keeping up with you on social media. I had some health issues, but I am back doing well. And so I appreciate the invite to be a part of the information you're putting out here. And boy, you make me feel good. I'm going to have to be on more often and get all these nice compliments. I appreciate it. So
Congress, and I know you've done a ton of YouTubes. You're a YouTube sensation. So what do you want to talk about for our listeners? We're going to get to Inflation Reduction Act, going to get to small business owners taxes, going to talk about the 90,000 new IRS agents. We'll get to all that. But what is the number one thing that's keeping you up at night as a CPA?
What's keeping me up at night, to be honest with you, is the hurricane that went on, because I do have a couple of clients down there. So very quickly on that, the IRS has announced that if you're in an affected area, which they've announced what those specific areas are at irs.gov, that between basically the end of September through February 15th of 2023, anything that's due between that period is not due till February 15th, including your 21 returns, SEP contributions, payroll reports, et cetera. The other thing is that the SBA, a lot of people don't know this, we learned a lot about the SBA and the economic injury disaster loan throughout the pandemic because it was extended to those that were being affected by the closures. But the EIDL is available also for natural disasters. So up to $2 million for small business owners for property damage, as well as making, in essence, their bills and payroll. And then also they have programs, loans for homeowners up to $240,000, and even for renters that have no insurance otherwise, up to $40,000. And of course, FEMA is a great opportunity there. So that kind of covers that area. But on the Inflation Reduction Act, what's your thoughts on it, Josh? I know that it had a lot of tax provisions, but it had a lot of green energy provisions. I didn't see that it really technically raised taxes on kind of the normal level of taxpayer. But what was kind of your thoughts out of it in terms of the overall aspect of it, in theory, really not reducing anything related to inflation? I think that's a fact, not really a political statement.
It was horrible. I think we would be lucky if it wasn't. I do like the energy. We had some energy expert on a few months ago or a month ago, and he was saying the energy, and I do want your take on that. The energy credits make solar a really good investment. If you have a home or a commercial building, solar is a winner. You're a winner if you do solar. But the IRS agents kind of scare me. It seems like they're going to go after the hairdresser who takes $100 from Venmo. You know, your favorite Italian barber who cuts your hair for $20. Screw that guy, right? You know, hurt the small business. So it should be called the Small Business Owner Screw Job Plan. So what you learn a lot about people that you don't really need to know.
Yep.
And here's the thing. I think they're going to use all that money to like have some type of mass AI on Venmo and go after crypto and go after Bitcoin millionaires. And I'm all for going after people who are truly cheating, but it seems like they're just going after the little guy with this. What's your take?
Well, I think that really ultimately what we're going to see out of this increased spending, it was $80 billion out of the Inflation Reduction Act that's in essence earmarked for the IRS on top of their regular budget. About 40 billion of it is going towards enforcement actions. But what's interesting is when you do look at the statistics of IRS agents that are retiring in the next 10 years, it's actually a staggering number. But I do typically tell people, well, the normal budget's going to replace those. So we really will see an increase in the number of agents, but we're going to see it in customer service. On the enforcement side, Josh, I would probably, as a professional in tax, would probably estimate a staggering number to you, but I believe there is probably over $500 billion in unpaid payroll taxes when we take into account penalties and interest. And so these are employers that are withholding taxes from their employees, but then not sending in those employee dollars to the IRS. So I think there's going to be a big collection process there where a lot of enforcement will go to that. I also think with the audits,
so
there's going to be
too bad. That was a positive. There you go.
Yeah. And I do think with the enforcement, when they say they're going to go after the wealthy, I think they'll be looking at what you just indicated, the crypto, the offshore. I think they'll be looking at businesses that
I don't mind that.
are
I don't
large
mind going
and-
after crypto tax cheats. I don't mind that.
Right.
Okay. So
Yeah.
So you're
I
pretty
agree.
positive. You're not as negative then.
I know it. I really think where we're going to see the
What, do you go to a Tony
IRS
Robbins event? You walk on coals? You're very positive today.
Well, here's where it's going to be, though. You hit on a key term here, AI. And so when you look at things that we're now having to report, minor example, S corps have to now file those owners a new form 7203. The IRS is now tracking more information than ever. And I don't mean that they have a camera in your house. I'm talking about on your tax return. And so there is going to be more audits in the future. But here's the audits of the future: a letter, a phone call. And in essence, there are going to be a lot of correspondence audits because they're going to just key in on some things. You make a good point on the Venmo, as well as anything else out there. Now, I do think those, the Venmo and Cash App and all, I think they've tried really hard to identify those accounts that are truly for business. But here's what I tell people is if your kid gets a 1099K, well, then report it on the return, report it as a negative. It should take care of it. I do think it's a good thing that we now have additional filings at that level, because I think there's a ton of people that are making income and they're not paying taxes on it. Now, hear me on this, Josh, and you know this, you know me well enough. I'm all for, as my tax professor said when I went to Abilene Christian University, graduated back before the turn of the century in 1993, but he said, our job as taxpayers is to pay our fair share, no more, no less. So we know the laws, we take advantage of them appropriately, and we pay the correct amount of tax. But when you're not reporting income, there's really no getting around that. And so honestly, I'm not really a fan of those that aren't paying their fair share, as in not reporting income. And I think that 1099K
I agree with that. Yeah, for sure.
is going to pick that up. So I guess where I'm coming at with Josh is I really don't see, in just in my humble opinion, us actually seeing an increase in the audits to the good, hardworking barbers, unless AI takes into
they're doing what
account
they shouldn't be doing.
how much
anyway.
they should be showing as revenue. So it may be an AI situation.
Yeah, somebody said I had one CPA who seemed to calculate that they're going to spend it on AI, but he was doing something with the numbers of the budget, and he said, well, yeah, they're doing this on AI, doing this on software monetization, but that's on top of the 90,000 agents.
Yeah.
So he thought that will, although it'll go after the tax cheats, which is good, it's going to go after some of the hardworking business owners. He thought it would really just have an adverse effect, but I'm glad you're positive. So,
well, the thing is that there's going to be an increase in audits. And so here's what we have to keep in mind is that before the pandemic, I believe it was 2019, the IRS only audited less than 500 S corps and less than 500 partnerships when you talk about traditional audit.
wow.
So what we have to be mindful of is if we do see headlines where, audits have tripled and quadrupled, well, it might mean that they're doing 2,000 audits when there's millions and millions.
Wait,
and millions.
2,000 a year or a day?
No. I'm saying that they did 500 audits the entire year of 19 on S corps and less than 500 audits the entire year of 19 on partnerships. That was something that was being reported on. So very few.
So that'll probably triple or quadruple for sure.
Easy, but that might be that there's only a couple thousand. There's millions and millions. So here's what I advise. I talk about it on my YouTube channel.
Let's talk more. Let's talk about this Inflation Reduction Act. I had a guy one time who was talking about the energy thing, and he's been great on that. But I sometimes get confused. What is different in the energy? So maybe I'm selfish. So it's all about, what's it? What do they say? What's in it for UFM?
Right.
What is it? WIFFY? So let's say I want to buy solar on my house. Do I do it next year or this year?
Well, the good news is that it is now in play through 2032, these provisions that we're seeing out of the Inflation Reduction Act. Really what that comes down to is that with these being credits, you want to pick a year where you have the most tax because credits offset your tax dollar for dollar. But here's what I'm not a fan of out of the Inflation Reduction Act. And I don't mean to say it was sour grapes because I do think that getting tax credits is a great thing. But similar to what I'm going to tell you related to vehicles now, is that if you make too much, you actually don't get the credit. So let me give you an example. The vehicles now that are hybrid or vehicles that are electric plug-in. So if it's an SUV, if it's more than 80,000 new, you don't get the credit. If it's a sedan more than 55,000, you don't get the credit. Now let's say that you get a vehicle that is under those dollar amounts I just listed. Well, if you are married filing jointly and you make more than 300,000, you don't get the credit. You're single, make more than 150, you don't get the credit. They have added a used vehicle tax credit for the type of vehicles. It has to be at least 2 model years old. And that credit is no more than a $25,000 cost basis, not the credit's 25 grand, but then they only allow basically up to $6,000 credit on that. But if you make more than 150,000 married, filing jointly, you don't get the credit. So you have to look carefully because there's so many different categories here that some of the credits are from the old law that do not have any income provisions typically that limit it, if you will. But some under the new law, there's going to be limitations. And so here's what I would say. Don't take the honest, hardworking solar panel salesperson's word for it. Not saying that they're going to lead you astray, but you got to coordinate this with your tax advisor and make sure that whatever is being sold to you is going to, in fact, qualify. And then make sure that you're picking the year in which you'd actually be able to take full advantage of it.
Wow. We're with JJ, the CPA here. So, okay. Give me some help, JJ. So if I want to put solar on my building, do I do it this year or do I do it next year? Or does it not really matter?
Most likely you would do it next year. And the only reason I say that is that you'd probably want it to fall under the new law unless you're getting one that has the new restrictions. And here's why I say that is that typically you don't get to take the credit until it's installed. So coming up late to the end of the year, I don't know that you'd be able to get it installed this year anyways. So I don't think you would want to plan on trying to do it this year. So this year and next year, I don't know of a difference other than you'd want to pick a year where you have higher tax so that that credit would offset it.
Okay, so there's no increased credit for next year versus this year.
No, there's going to, and I'm giving you a political answer here, Josh, and I don't mean to, but there's actually so many different kinds of these credits.
I've read this. It's
some have gone away, some are new, some are expanded. And that's really where we don't actually have anything from the IRS that tells us these details, only because they just haven't had time to come out with it. So I don't really have an answer for you because we don't have it. We don't have the minutia. All we have is the bill. We need the IRS to come out with an IRS notice and identify these things very carefully. So I would probably say this, to be safe, I'd wait till next year. unless they come out with something here soon, and they very well may.
Yeah. But if you're buying a Tesla, buy the Tesla this year, not next year, because next year, well, if it's above a certain amount, you don't get the credit as much.
Yeah, so thank you for bringing that up, because Tesla has sent letters. They were very proactive with this to those that ordered a vehicle before the new law to tell them their purchase falls under the old law where there wouldn't be this limitation. So that new law went into play this year, though. So really, if you have not bought a Tesla, meaning you don't have one on order, then you're probably going to be under these income limitations already, because these things didn't necessarily go into effect next year. Some of them have gone into effect as of the date of the enactment of the Inflation Reduction Act.
So we're talking about Inflation Reduction Act. So what else do we need to know about the Inflation Reduction Act before we go to small business owner tax stuff?
Now, let me tell you this. When we go to small business owner, we've had some of your followers and listeners on the edge of their seats before the last break on what that Italian borrower needs to do. So when we get to the small business, we got to take everybody off the edge of their seats on that, because I do have some very quick advice.
Well, let's do that first, since we had a little cliffhanger.
Yeah. So with that, here's what you need to do. So you know what's going to be a top 10 audit is those that file Schedule C. Now, I get it right now. There's probably tax professionals in essence are saying, oh, that's a fallacy and it's not really a red flag and this and that. Well, here's the bottom line. When you look statistically at where IRS adjustments come from, it's from those that file the Schedule C, which is the sole proprietor. So if you have a barber, they don't set up an entity, they're not filing a separate tax return for their business, then where they're reporting it on is Schedule C. So there are some multi-level marketing companies back in the 80s and 90s that ruined it for everybody else, that showed how to write off expenses that you really can't. And then it has stuck as, in essence, an easy target for the IRS. Now, don't get me wrong, if you're filing a Schedule C and you get an audit, big deal. If you've reported your income and your expenses are right, then you got no problems. But if you're filing a Schedule C, you're a target. So how would you not be a target? Well, set yourself up as an LLC, elect for you to be an S Corp if you're actively involved. Here's the other thing, Josh. Here's the golden nugget. It's probably a golden boulder, is that when you file a Schedule C as a sole proprietor on your individual return, which is where you would report your income and expenses directly on your individual return, whatever the net income is, it is subject to 15.3% up to $147,022. If you're an S Corp, you don't have those taxes at all. Yes, it does potentially affect your Social Security, but here's how it doesn't affect your Social Security. You pay yourself some wages out of your S Corp to still max out your Social Security. So you're doing two things at once. You're giving yourself better audit protection, giving yourself better liability protection as well, but you're also reducing down your taxes overall. So that would be the number one thing I would be telling Schedule C filers is get off your Schedule C and onto an S Corp return. So I've got a number of videos talking about this. It's really not that difficult.
Wow. So if you're going, when you got to elect? You got to elect now by October 15th, 2022, or you're kind of screwed for last year. You can only do it for next year.
So there's 3 due dates. I'm just going to tell you the last one. You have until the due date of the tax return. So if you are going to elect it for 22, you would have until March 15th of 23. But if you file an extension for that entity, you would actually then have till September 15th of 2023 to file the Form 2553. So no, it is not too late if you've already had an LLC set up this year, which a lot of Schedule C filers are an LLC, but they're not an S Corp. Now, if you set up the LLC today, Josh, well, then you can start being an S Corp the day you set up your LLC. And the normal time period of filing that Form 2553 to be an S Corp is 75 days after you start the business. But it's something that the IRS gives you other time periods to follow up on that. So I never tell anybody, hey, if you're past the 75 days, no worries. We just now file under a late election that allows you to still be an S corp. So it's something that definitely needs to be looked at hard.
So what is the taxable fringe benefit form? What's it called again? Form what?
Well, that's just going to be reported on your Form W-2. And that is then, in essence, your personal use of a business vehicle that's owned by the business. And that taxable fringe benefit is something that's then picked up in box 1, 3, and 5. All that means is it's considered wages subject to taxes. It's wages subject to Social Security and Medicare taxes. But here's the beauty of this, Josh, is that you get a vehicle, it's owned by your S corp. Let's say it's a $60,000 vehicle that is owned, titled, paid for through the S corp. You write off your insurance, your gas, your car washes, everything related to that vehicle. If you then go through the trouble of figuring out what your personal use is, which is simply based on how many miles did you drive personally in that business vehicle, and commuting does not count as personal miles in most circumstances, then come time to, in essence, report your Form W-2, you figure out what your percentage of personal use is. You go to the lease tables that the IRS has. And here's what I'm telling you, Josh, not even being aggressive. I mean, most of my clients, it's, 30, maybe 35% personal usage. Most of the time we're getting this $60,000, $70,000, $80,000 write-off, and the taxable fringe benefit might be only $3,000, $4,000. But that allows for that full write-off. So in essence, if you don't have a vehicle in your business, then you probably need to get with somebody and don't be talked out of it. If you have an advisor that says, no, you're going to get audited, or no, and they just shut you down, challenge them to say, I need you to tell me more about this. I need you to tell me why, because I'm not scared of the IRS. I'm sorry that you are tax advisor. For some reason, you're scared of the IRS. I don't know why that is. It must be because you're no good. So continue to tell me more. Don't just tell me that the IRS isn't going to like it or it's a flag. Because I'm going to tell you this, in 30 years, this is me knocking on wood, Josh. In 30 years, I've never had an IRS adjustment on a return that I prepared, because we simply do it right. And I've had this very thing audited a number of times, and it's gone through with flying colors. And in essence, do that business use or the personal use.
Wonderful. Some people suggest, if you have two cars, make one personal, one business, and just use one solely for business and one solely for home? Do you recommend that? Or?
Yeah, absolutely. Unless you have, because I have clients and very sincerely, both of the spouses are employees of the business. And so then both vehicles are in that. But to your point, if you are one owner, one employee, or there's really not a spouse involved and you have a household vehicle, then yes, really it would make sense to just have one vehicle in there. And here's the other thing, though, is that for that vehicle that you personally own, any miles that you drive on it for business, even though it's personally owned, you get to reimburse yourself. You get to write yourself a check from your business. Now, this would be S Corp, C Corp, and partnerships. Sole proprietors just get to write it off. But you get to write yourself a check that is tax-free to you by law, by statute, and it's a deduction to your business. The mileage rate was 58.5 cents a mile for January through June of this year, and it's 62.5 cents a mile from July through the end of this year. So if you just drive 1,000 miles throughout the year, I mean, you're looking at around a $500 check that's tax-free to you. You drive 10,000 miles, it's 5,000. So bottom line is you still can get deductions on both. It just depends on your business usage of each vehicle.
No, beautiful. We're getting so many great questions answered. What about apps? Do you like certain apps for deducting mileage or tracking that, or not really?
No, I'm a big fan of them. I kind of learned the hard way not to even recommend to my own clients any apps, because some of them, they're here today, gone tomorrow. Some are inaccurate. Some you get to year end and the reports don't actually spit out what you thought. So all I'm saying is I am a big fan of those. I don't have a particular favorite because I did have a favorite and it went kaput, and it kind of put my client and I in a bind because they had been tracking all of that, and then the app was no longer. So what I would say is whatever app you're using regularly, take the information and put it into your own system, a screenshot or some kind of a PDF. But I am a big fan of those because here's the thing that many people don't know, Josh, is that you can track your miles and your usage all 12 months, but you can pick the 3 highest months and use that to determine, in essence, what your usage is for that vehicle. The IRS allows you, in essence, to do a sampling. So that's another benefit of tracking all 12 months. And then at the end of the year going, well, what were my best 3 months here in terms of business use? And then I'm going to use that because the IRS allows that.
Fantastic. So JJ, give us some more tax tips.
Well, here's the thing. Just what we were talking about there is that when we start working with a new client. So we were talking earlier, my son Cooper, he's a sophomore in college and getting ready to play ball this spring, but he is on his way to becoming a CPA. But he brought in his first client last week. Somebody had called and needed some help. And when we sat down with this young man, I walked through with Coop and this new client that there's really no magic for a small business owner in, well, tell me what it is I need to write off. The magic is for you to inverse your thinking. Now, I don't mean it with a smirk and unethically, but you have to reverse your thinking. What I tell people is, here's what you can't write off, and everything else is a possible write-off, right? So if I were to say, hey, do you think we can write off ballet shoes, right? Everyone would probably be like, no, you can't write off ballet shoes. Well, what can you write off a motorcycle? Well, no, you can't write off a motorcycle. Well, if you're a business that in essence is a ballet studio, well, then you get to write off ballet shoes. So my point in saying this with the motorcycle, okay, well, if that's a vehicle that's in essence being bought, it's housed, it's in the front area of the company, it's in their waiting room, it's something that's part of their social media, something that's in essence a promotion that's then also ridden by the owner for business purposes. Yeah, we get to write it off just like we would anything else. The point is that if there's a connection between the expense and your business, that's really what you have to look for. Next, you need the receipt. Next, you need to show that your business paid for it. That means your bank account paid for it. Or if you used a credit card, then your business bank account paid the credit card. But having the receipt, showing that your business paid for it, but really, how is that expense related to your business? So I'm going to tell you a little something that I do just because I'm very interested in tax deductions. But when I go to the grocery store, so I'm going into Target or Walmart, right? Sam's Club. I walk in with two cards, two credit cards. And when I'm in the checkout line, things that are going to the office, well, I'm going to put it on the business card. So that toilet paper and paper towels and Cokes and the coffee and you name it, cleaning materials. Then things that I'm like, yeah, this is personal. You know, I'm not having a big vegetable tray. So if I'm not bringing a vegetable tray, then my carrots, well, those are personal. If I've got, personal Oreos and I'm not taking them to the office, well, then those are going to be personal. So I ring up every time I go separate to then go, well, these are the things that were related to my business. Here's my receipt. My business paid for it. If I had to credit card charge it, my business bank account paid that credit card. So it's attaching it. So what I usually tell people is, here's what you definitely can't deduct: clothing. So what we're wearing today, right? We're not able to deduct because what the law says is. I was going to ask
you about that. Yeah. I'm always trying to, but can't you, but theoretically, right? I asked this maybe to you one time. If everybody wore that outfit at your office, you could do it, right? Because it would be deemed
Absolutely.
a uniform. So we're
Absolutely.
doing uniforms.
Now it would be that the business paid for it. And yeah, if this is this, it would be, though, when you quit, you don't get to take it with you.
Okay.
Now, I would say also, if you're ruining it by putting on some big crest right here, or something on each shoulder, because the way the law reads is that it literally says, if it's clothing that you would wear on the street, this is how the law is written, in your normal, ordinary day, then it's not something that is a deduction. But you're right, because I do know this, if you are creating a movie and you're buying wardrobe, if you're doing a play and you're buying wardrobe, probably could make an argument with some that are in the news, maybe that would be you, that, okay, I had to buy these suits and things to that effect. So there's a gray area there. We know that our former president came under fire because he said, oh, well, his haircuts were paid for by the business that had his show and the clothing. And it's like, yeah, but that's just allowed. It was in essence allowable because it was tied to what he was doing for business. So at the end of the day, you really, in essence, are what can you tie together? And to your point, if it's something that's required or everybody's wearing it. Now you see, there's people out there, Josh, we have to be careful of, that they're like, well, I'm the only employee and I'm going to require myself to wear a suit every day, therefore I can write off my suit. Well, no, the IRS, in my opinion, would shoot that down, because it's like, well, that's clothing that you would wear on the street. You establishing a requirement for yourself, you're more than a 50% owner. You can't necessarily follow through and compel yourself to do anything as the owner. So my point is, you just have to be smart about these things. The key is, if inquired upon, are you able to say, well, I only spent that because of my business, right? So if you can find another reason that you did something, then maybe it's not related to the business. What would be an example of that, right? Somebody's like, well, I'm going to buy a MacBook for my office, but I'm just going to let my kid use it and I'm never going to bring it to the office, right? Well, I'm sorry. I mean, you just told me that your kid's going to use it and it's not in the office. So no, you're not going to be able to write that off. But if you have a computer at the office that's available at the office that is used for office purposes, your kid comes to the office, works on it, no problem. If you take it home and bring it back, no problem. The IRS indicates that you don't have to track that kind of usage. So there's people that unfortunately, in essence, hear these things and then they just go kind of a little harebrained on it. So you have to just be, in essence, smart about what it is that you're running through.
Oh, fantastic. What other tax things do we need to know? EIDL, ERTC, any of that stuff? The ERTC, you mentioned the EIDL, but so anything with ERTC?
The EIDL, I'm glad you brought that up, because if you got the EIDL in the early part of the pandemic, which would have been April and May of 2020, they extended those payments out 30 months. And so many are now going to see that they've got to start making payments on their EIDL, not the grants, but that's a 30-year loan, 3.75%. You got to log into the SBA in a new account to make the payment. So the account that you had when you got the loan with the SBA is no longer available. You can't log into it. You have to go to the SBA and use your, in essence, loan number to set up a new account to track it. You have to also set up a separate account with the U.S. Treasury, which the SBA gives you a link to make your payments on the EIDL. So you need 2 new portals to make a payment. The other thing is related to PPP. If there's anybody that hasn't filed for forgiveness, the thing to note is that you do have 5 years from the date of disbursement to file for PPP loan forgiveness. Now, your payments no longer are deferred, so you would be making payments if you haven't filed for forgiveness, but don't let anybody tell you that it's too late to file, because you have 5 years, which is to the maturity date of the PPP loan. If you are making payments on a PPP loan and had not filed for forgiveness, then you make the payments. Yes, there'll be a little bit of interest, 1%. But when it gets forgiven, you're going to get refunded all of that. On the employee retention tax credit, out of the CARES Act, that's where it came into be. When it first came out in 2020, you couldn't get the employee retention tax credit if you got PPP. Well, at the end of 2020, they changed that law and said, you know what, you can get both. So if you're an employer and you pay W-2 wages to employees from March 13th of 2020 through September 30th of 21, and you had any effect to your business due to a governmental order, you qualify to get a credit for that time period. There's another distinct qualification, which is if your gross receipts are down, then your entire quarter of wages can be included for the credit. It has to be down 50% in 2020 compared to 19, quarter by quarter. Only 20% in 21 compared to 2019. There's a number of things. Now, I will tell you this, Josh, the seminar that I've got put together, it's $197, but I give you all the spreadsheets, Excel. It's a 3-hour seminar, instant access to it. Here's my point. I want to make sure that I really get this one across. Do not pay a contingency fee to anybody to help you with this, because it's really not that difficult. It may seem to be, but it's not. So don't allow yourself to have somebody call you, convince you to hire them, and then they're going to take a percentage of what your credit is. The IRS and the AICPA have said that is not allowed. Now, there's some sneaky people out there. They're super sly, and they found a way to still charge you the commission or the contingency fee because they're not your preparer. They're not going to sign anything. They're not going to stand with you. That means, in my opinion, that's not somebody worthy of helping you. So at the end of the day, do not miss out on the ERTC. If you got wages, you need to figure this part out. If you paid wages, your business was down, you were affected by a governmental order, and you haven't done this, you have until at least July of 2023 to go back.
What's a governmental order besides COVID? What else would classify that?
No, really, it would just be a governmental order due to the pandemic. So if there was a governmental order where, in essence, your business had to be closed or partially closed. For restaurants, if they said, you can only have 80% capacity, or only so many people can be in your store at this time, or anything that,
so it's
in essence,
really just COVID related, nothing else.
Yes,
okay.
yes.
And
yeah,
then
thanks for
the
that.
quarter by quarter, if someone's company did worse fourth quarter 2021 as opposed to fourth quarter 2019, does that count or no? It has to be.
No, unfortunately, with the Infrastructure Act, it did away with fourth quarter 21 unless you're a recovery startup business, which it's so rare anybody would be a recovery startup business. It's somebody that started a business after February 15th of 2020. So this is first, second, and third quarter of 2021. If it's down at least 20% compared to that applicable quarter in 2019, then the wages for the entire quarter are available. Now, it's only up to $10,000 of wages per employee, but that means that it could be a maximum of $7,000 credit per employee in first quarter, a maximum $7,000 credit in second quarter of 21, maximum of $7,000 in third quarter. That's a maximum of $21,000 per employee. Here's the thing. If you own more than 50%, if you and your family own more than 50%, and you have a living blood relative, you don't qualify. I covered in my seminar, but under Code Section 267C4, it's plain in IRS Notice 21-49. It's plain that if you're an owner in the business and you own more than 50%, and collectively your family owns more than 50%, you're not going to qualify for this. Husband and a wife, they each own 50%. They collectively own 100. They're a majority owner. The only way they're going to qualify is if neither spouse has any blood relatives, which is very, very rare. So it sounds weird to say this, but literally, if you're not an orphan, to use this word, if you're not an orphan and you own collectively with family more than 50%, you don't qualify for the ERTC. Self-employed don't qualify. But here's what the takeaway is. Do you have employees that you're paying wages to? Were you affected by a governmental order due to COVID? Or were your gross receipts down? Let me tell you this. People have taken my seminar, and this is no joke, getting millions back. Now, obviously, these are bigger employers.
Wow.
But if you just have, I'm going to run some quick math here, if you don't mind. let's just say somebody has 4 employees and they're $12 an hour each. I get that's low, and they're each full-time. So in a week, they have wages of $19.20. If we just say that there is going to be 12 weeks in a quarter, that's $23,000 in wages, which means on that employer, 4 employees, full-time, $12 an hour, that's 16 grand back for 1 quarter. That would be what would that be? $48,000 back in 2021. People are missing this all over the place. They should not. So I've got a seminar people can get immediate access to that walks it through. They don't have to necessarily pull anybody else in, walks them through A to Z.